My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com. All right, let's react to 7 stocks to buy now, January 2025, by Jeremy Financial Education. Overall, my thoughts on Jeremy are that he receives a lot of backlash, probably an unfair amount when you compare it to many of the other creators like Felix Pren, who, in my opinion, are 1,000 times worse than Jeremy. And I've come to Jeremy's defense a few times, but regardless of that, I'm going to be non-biased in this review, and I haven't gone through this video previously, so let's see what 7 stocks he recommends. Also, because it's 46 minutes, there's no way that I have the attention span to go through the entire video. So we're going to be jumping around a lot.
7 stocks I'm buying, January 2025 edition. Welcome in, folks. 2025 with stocks I'm actively putting money in right now. Okay. Now, real quick, I think this is worth mentioning. Make sure you stay focused in 2025 on the long term. Don't get caught up in all the short-term stuff. There's going to be a lot of drama this year. Make sure you're adding to positions that you're happy to be in and buying stocks that you're happy to be in for the next 3 years, 5 years, 7 years, 10 years, right? And not getting caught up in the day-to-day price action.
I definitely agree with that. A lot of people, they trade in and out of positions, when in reality, the best thing that you can do is go long market-leading companies with strong brands that you believe 5 or 10 years from now are going to be trading higher than they are right now.
That's going to be out there because it's going to be volatile, which could create some great buying opportunities throughout the year, okay? And a lot of money to be made on both sides of it, okay? Appreciate y'all for being here as always.
I think it's pretty cool that he put together an entire presentation that shows that he put forth a decent amount of effort. All right, let's get to his recommendations. First is SoFi.
And 2, I would think about them as a new age bank that's digital first, not branch focused like the old traditional banks like Wells Fargo, Bank of America, JP Morgan, those sorts of older bank companies, right? They're digital first. They really attract a lot of the millennials, Gen Z, and I think they're very well positioned that when Gen Alpha goes to get bank accounts, I think there's going to be a whole lot of them that are going to be signed up for SoFi Technologies.
My issue with SoFi is that it's gotten a tremendous amount of hype. And it's performed pretty well, but it hasn't gone up as much as I would have expected, considering how much free publicity and free promotion it's received.
When you look at SoFi here, right? Look at the revenue chart of this company over the last number of years on a trailing 12-month basis. Look at that. I mean, the moral of the story is if you don't know much about stocks, usually when you buy companies that their revenue just goes up and up and up and up and up and up and up, usually going to do very well in that company. This company was nothing but a money loser for the longest time on the bottom line.
All right, so we'll check out what the second one is, and then we'll go through my thoughts on all 7 after we find out what they are. All right, number 2 is AMD. ELF is number 3.
Earnings per share growth cycle. It's going to start in this company. They now have the new CEO running this company for the last couple of months.
Nike.
I expect no.
Nike is number 4.
This is called Big Good Changes in 2025 and 2026. So you had a CEO that was running the company into the ground.
Cheesecake Factory is number 5.
30 restaurants as well. They talk about maybe being able to take it up to like 300 domestic locations long term in regards to a Cheesecake Factory. We'll see what happens with that, right? But that's great. Cash cow business, very successful. We know with Cheesecake, right? Also super high unit volumes. I mean, look at this, $12 million plus unit volumes for Cheesecake. So the Cheesecake Factory concept is a absolute animal cash flow machine.
I've actually never eaten at Cheesecake Factory, probably because I'm too OCD about health-related stuff.
Successful restaurant brand, one of the most successful in history, right? And that's great. Like, that's the ATM machine for this company. But let me be very clear, the reason I'm invested in, so this is a crazy big opportunity. Is it a Chipotle type opportunity? I wouldn't go that far. But yet, look at how well they got through the great financial crisis. One, their restaurant sales weren't down nearly as much as their competition, right? Additionally, I want you to pay attention right here. This shows you adjusted earnings or loss per share in 2009, 2010. 2009, 2010 was a disaster economy, massively high unemployment, right? Not a good time to be in the restaurant business. A lot of restaurants went under in 2009, 2010. And then look at how Cheesecake did. $1.07 in 2009 and $1.42 in 2010. Keep in mind, this is a much weaker company back then than the Cheesecake you see nowadays. Look at free cash flow. Free cash flow of 106 buybacks from 29 cents to 33 cents. Then they upped it going in 2020 from 33 cents.
He's really pushing Cheesecake Factory. It's been about 14 minutes. I think this is a win.
Oil money, very diverse high-end business. A lot of the top 10% of the income earners, top 10% of the wealthy like to go to those sorts of properties. If you're going to Macau, if you're going to Vegas, if you're going to Boston, and then when this Middle East property opens up, right? No, the stock price performance for this company has really been out of their hands over the past 5 years, right? It's kind of unfortunate, kind of billions of dollars of debt, right? And no one wants to own those sorts of stocks when the Fed goes wild like that in terms of just raising interest rates. And so it had two very existential issues that happened to its stock price that were completely out of its hands. It's like they couldn't control if the Fed was going to raise rates, like they did. They couldn't control the government was going to shut down the worldwide economy, but they did. And so really this company's stock price has not been in their hands the past 5 years, but I do believe that's going to be very different over the next 5 years. I do not believe we're about to go through any sort of major hike cycle for the Fed, and I do not believe we're going to go through another once in 100-year health event, right? Now, in regards to Wynn Resorts here, right, you look on a trailing 12-month basis in terms of the revenues of this company.
Yeah, Wynn is very solid. I like buying companies that are strong brands. When I went to Las Vegas almost 2 years ago, I ate at the Wynn Buffet. And it wasn't cheap. At that time, it was about $90 a person. But the reason why I wanted to do it was that the Wynn Buffet is known as the best of the best. And I wanted to experience that. So even though it wasn't inexpensive, I looked at it as an experience. And it definitely did not disappoint. It was fantastic. And then walking around the Wynn, I got the impression that it was more upscale. The ambiance was better than in other hotels that I had walked through in Las Vegas. So yeah, there's definitely something to be said. That type of prestige and that type of branding can command higher prices. So while I haven't looked at the financials here, I think he makes a good point that over the past 5 years, when you have the virus and then you also have the Fed raising rates, that's an environment that's not conducive to Wynn Resorts. And there's a decent chance that the next 5 years are going to be more accommodating for Wynn than the past 5 years.
I mean, they've climbed substantially. Now, analysts have gotten, I would say, pretty bearish overall, where they don't have much revenue growth going for Wynn at all, right? And we'll see if that comes true. They might be a little too conservative in regards to 25, 26 for this company, right? Now, additionally, look at trailing 12-month free cash flow for Wynn Resorts. Well, I mean, what a change, right? And this was basically government forced shutdowns and all that stuff, right? And obviously they were losing a fortune, and man, have they changed the free cash flow story in regards to this company in a major way. Additionally, just as important, look at the operating income for Wynn Resorts, right? You don't have to be a stock market genius to look at that chart and be like, dang, it's pretty darn impressive what they've done with operating income there, right? Well, another way I like to think about Wynn is not just like all the money they're bringing in, right? What's going on with their revenues and their EBITDA, right? Because do remember, EBITDA is very important for a company like Wynn Resorts. And the reason being is a company like this takes a massive depreciation amortization every year. Like we're talking many hundreds of millions of dollars every year, which makes them look not as profitable as they really are, okay? Says why EBITDA is very important for these sorts of resort names, right? The enterprise value is very important to look at for companies like this.
So regarding EBITDA, first I'll explain it in banker talk, and then I'll explain it much more simply. EBITDA neutralizes the capitalization structure of the company. What that means is that it takes the company's operating income, which is also called EBIT, and then it simply adds back the depreciation and amortization, which is found on the cash flow statement. Finance people like to look at this number because it doesn't take into account the amount of debt that the company has on its balance sheet. So it's a way of focusing solely on the core business and seeing how profitable it is from operations.
You looked at, and the reason enterprise value is it takes its market cap versus debts, okay? So you get a real better understanding, at least in my personal opinion, of what you're actually paying for the company. So enterprise value is $20 billion.
Right, so enterprise value is the market capitalization of the company plus the net debt, which means that you add the company's debt and then you subtract the cash.
I don't believe you could build all of Wynn's properties for $20 billion. I don't think it's happening. And so that gives me a lot of comfort in thinking like, let's say you could have the culture in the employee force. And
so that's a good point. And it's similar to the concept that Warren Buffett preaches, where he looks at book value. And if he believes that you can acquire the assets of the company for cheaper than it's being valued in the market, then Warren Buffett is interested in investing. I guess the only issue that I have is private equity firms are constantly looking for new deals, and they can add debt on these companies and use the underlying assets as security. So if Wynn's assets are more valuable than the enterprise value, I would think that you would have tons of private equity firms trying to acquire shares and take this company private. And I haven't looked at the ownership table of Wynn, and it's definitely possible that Steve Wynn has a controlling interest. So maybe there's a poison pill in there, but it does make sense. $20 billion for a private equity firm is not that high, even if they paid a 20% premium.
The design and everything Wynn has, right? And the unbelievable customer base they have. But what if you just try to replicate the properties? I don't think you could do it for $20 billion. Not with how expensive construction is nowadays. There's no way you're building all their properties, in my opinion, for $20 billion. So that gives me some comfort, right? Additionally, dividend payer, obviously, with this one, and I think the company's going to be paying much bigger dividends over this next 5 years, especially if they don't do the New York property, which I have a lower and lower belief that they're going to do the New York property. The dividends are going to be substantial here. And as far as the land in Vegas, I don't see them building anything on that land yet either. And the reason being is the north end of the strip has two problem properties already having an issue. Fontainebleau is having a lot of issues from what I'm hearing on the ground. Resorts World's having a lot of issues from what I'm hearing on the ground. I have a hard time believing that Wynn's going to bend over backwards for New York. I think it's going to be true.
Well, yeah, that makes sense. New York is becoming less desirable. If you look at what happened when Amazon wanted to build the headquarters there, they were treated very poorly. And building in New York is extremely expensive. You have to get approval from community boards and zoning and the Department of Buildings. It's a mess.
It'd be an incredible opportunity, but I see it not. The lease property opens and the cash flow start pouring in for that. They can raise a dividend off. The thing is, my position's almost built out where I want it built out.
All right. So the last one is Celsius, which I'm not familiar with. So let's give him a few minutes to explain his thesis.
So it's not very likely that you'll see me continue to buy Celsius after January, essentially. But I'm doing a combo buy here where I'm buying Celsius and buying Monster. And basically putting $1 in Monster for every $2 I put into Celsius roughly. And you can kind of see that. The reason being is Celsius obviously massive growth over the past 5 years. Went from a brand no one really knew about 5 years ago to now being, actually a very famous brand in the energy drink category, right? And my thought is, just in case Celsius falters over this next 5 years, I think the biggest one to benefit would be Monster, since they own Monster brand, Reign brand, a Bang Energy brand, and a few other brands as well. So they're kind of an energy drink giant. So my thought is, if Celsius falters, Monster picks it up, right? So it's kind of a hedge play a little bit. But in regards to Celsius here, it's basically almost a perfect kind of 2-to-1 ratio in terms of what I put into each of these stocks and kind of what I'm holding here. So very comfortable with what I'm doing there, a few months ago on Buy Elf and Celsius stock and don't stop. So if you want to hear me talk more in depth about Celsius, you can certainly check out that one there. As far as the health related stuff, obviously a lot of stuff went viral in the past year about, is Celsius healthy for you? I have news for folks like, I don't think any energy drink is ever going to be seen as healthy.
All right. So he has SoFi, AMD, Elf, Nike, Cheesecake Factory, Wynn, and Celsius. Let's check out each of them real quick, and then I'll rank them and give you my thoughts on each. So here you can see that I'm using stockanalysis.com. Let's look at SoFi. SoFi. It's a $16 billion company. Over the past year, it's up 80%, which is great. Over the past 5 years, it's up 35%, which is not so great. Looking at the financials, it has very strong revenue growth. Very strong. Its operating income over the past 12 months is positive, which it hadn't been previously. I guess my primary issue is that its margins are very low. And for an online bank that I don't believe has brick and mortar stores, I would hope that it would have margins that are higher than about 9%. Even so, it's definitely trending in the right direction. And SoFi is a young company, so it seems like those operating margins can increase significantly in the future. Let's look at the balance sheet. See how much net debt it has. So you can see that it's been paying off a lot of its debt. Previously, it had about $4.5 billion. Now it only has $964 million in debt, which is great. It's reducing its leverage. The cash flow statement, net cash flow, minus $327 million. That doesn't seem right. Maybe they repurchased shares or something like that. Let me see. Yeah, so it looks like they had a preferred share repurchase, which contributed heavily to the negative cash flow. I want to quickly see the shares outstanding. My gut feeling is that they're diluting. Yeah, they are diluting. You can see that they went from 40 million shares outstanding to here they issued a ton of equity. And now they have about 1 billion shares outstanding. So that's massive dilution. I would say overall though, SoFi seems okay. Out of 10, I would probably give it a 7. Let's look at AMD. AMD has a market cap of $206 billion. Over the past year, it's down. Over the past 5 years, it's up 163%. And it's been around for a really long time. Financials, its revenue growth. It seems like it used to be strong, but it had a really bad year in 2023. And then the past 12 months has turned positive again. Strong operating income. Shares outstanding are relatively stable over the years, even though there's been some dilution. Its gross margins are very high. Its operating margins are pretty low at only 5.6%. Profit margin, free cash flow. Its EBITDA margins are pretty high. Let's see for the balance sheet what its debt situation. It has a lot of cash. It has over $2 billion of cash on the balance sheet. And then the cash flow statement, it has really high depreciation and amortization. So overall with AMD, it's been around for a really long time. It's not a market-leading stock. Its lack of revenue growth bothers me significantly. And if you look at one of its peers, like Intel, which used to be a market leader, they've really fallen off to the point where they're not really relevant anymore. So AMD, because its revenue has basically flatlined and it's not a market leader, I would give AMD a 6 out of 10. Let's check out L. So Elf Beauty, 1 year, it's down 7%. 5 years, it's up 714%, which is amazing. It has a $7.2 billion market cap, which is very small. Income, wow, this thing's growing tremendously. And then gross profit, it has very high gross profit margins. Its operating expenses are very high. EPS, so it hasn't diluted itself that much. Let's look at the balance sheet real quick. It has about $200 million of debt, which is not terrible, but it's also not a small amount. And then looking at the cash flow statement, yeah, see they issued the debt recently. I think Elf is pretty solid. I know that beauty is a very competitive space. The best thing that this company has going for it is its top line revenue growth, which is tremendous. If you see that slow down, then I think that the stock is going to tumble. But if it's able to continue growing its top line and streamlining its operating margins, then I think it could be a good buy. The primary issue that I have is during 2023, when the market was up over 25%, Elf was actually down. So that's telling me that Elf has fallen out of favor because of that. And since the market cap is still really small at only $7 billion, I would give Elf a 5 out of 10. Nike. So right off the bat, Nike has an incredibly strong brand, and that by itself is probably worth billions of dollars. Market cap of 106 billion. Then you look at the financials. It has decreasing revenue. Over the past year, Nike is down around 30%. Over the past 5 years, Nike is also down around 30%, but its all-time returns are about 50,000%. It was trading at about $170 in the beginning of 2022, and now it's trading for less than half that. Financials, it has decreasing revenue. It's been buying back some of its shares as well, which is a good sign. Its margins are decent for an apparel company. Looking at the net debt, it has $2 billion of debt. And quickly at the cash flow statement. So I think with Nike, the issue is you would buy this company if you think that it's going to increase its sales, because that's the reason it's trading at about 40% of its all-time high. I'm not so sure whether Nike's going to be able to turn it around. I kind of feel like Nike, when I was younger, used to be super cool and everyone wanted to wear it, but now it's a little bit different. I think that buying it at 72 is very safe, and I think that you have some upside here. I would probably sell some put options on Nike with a strike price of about $60, or you can go long Nike by buying a call debit spread and then financing that by selling some put options. And then if you're assigned shares, you can then just run the wheel strategy and sell some covered calls against it. Given the current stock price where it's trading at about 40% of its all-time high, and that it still has a very strong brand, I would actually give Nike a 7, primarily because I think that the downside when it's trading at 72 is pretty limited. So it seems like a pretty safe investment to me. All right, Cheesecake Factory. Cheesecake Factory has a valuation of $2.5 billion. 1 year, it's up 50%. 5 years, it's up 27%. And then you can see its all-time high is about 65. Let's check out the financials. So, not strong revenue growth at all. Gross profit. Its margins are pretty healthy. The operating income is pretty low compared to the amount of revenue, but restaurants, they tend to run on small margins anyway. Let's check out the balance sheet for the debt. So it has about $1.8 billion in debt, which is a lot. And its debt is actually increased over time. And then let's see the amount of shares outstanding. Shares outstanding have actually been consistent, which is good. And then just briefly at the cash flow statement. It has a tremendous amount of debt, and also its revenue is not growing. So for Cheesecake Factory, I think there's a lot of risks involved, and I would give it a 3 out of 10. Let's check out Wynn. All right, so Wynn has a market cap of about $9 billion. Over the past year, it's down. Financials, you have very solid revenue growth, 25%. Has really strong gross margins. See, the interest expense is tremendous with Wynn. Shares outstanding have been relatively consistent over the past 5 years. Very high gross margins. It's growing its EBITDA. Let's look at the balance sheet. Yeah, it's also increasing its debt, which is something that I don't like. It actually has negative cash per share when you factor in the debt. And then from the cash flow basis, you have net income. It's going to have a lot of depreciation because it owns a lot of buildings. You like that it's investing in the business. That's what this capital expenditures are. So here it's been repurchasing a lot of its common stock. It repurchased around $340 million, which shows that the company has confidence in their stock. I guess the only issue that I have with Wynn is its very large debt position. I do think, given the strong revenue growth, that it's going to be able to pay off some of its debt and you have decreasing rates on the horizon. So for Wynn, when you factor that in, along with the strong brand equity, I would give this a 7 out of 10. All right, Celsius, last one. Celsius over the past year is down 50%. But 5 years is done very well. $7 billion market cap, financials. Its revenue is slowed down, only up 19%. Operating income. So it hasn't diluted itself that much. Gross margins are improving. My issue is the slowdown in the revenue and also the performance over the past year. Let's look at the debt. So it has a large cash position of around $900 million. So Celsius is not a market leader in its segment. And then when you factor in the poor performance over the past year and the fact that its revenue over the past year has slowed down significantly, even though it doesn't have any debt, I would give Celsius a 5 out of 10. I would rank them SoFi first, Nike second, Wynn third. I might actually switch Nike and Wynn, so you can choose which one you like better. Then fourth, I would put AMD. Fifth, I would put Elf. Sixth, I would put Celsius. And then seventh, I would put Cheesecake Factory. Let me know your thoughts below. And if you liked this video, then click on the video on your screen right now because YouTube believes that you would enjoy it the most. Visit beststockstrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and a review. If you have any questions, visit beststockstrategy.com and send me a message.